Hi, welcome back to the S&A Guide to Options. In the previous DVD series, we took a look at the 4 basic option strategies and showed you how you can use them to profit in the options market. We looked at buying calls, we looked at selling calls. We looked at buying puts, we looked at selling puts. Today we're going to build on that education, we're going to build on that experience, we're going to show you the exact stock setups where you can take those option strategies and produce profits. Now since we're talking about stocks, you have to be able to analyze stocks. We're buying options on stocks, so it makes sense to be able to understand how the stocks actually trade. Now when you're looking at analyzing stock positions, there's 2 ways to do it. There's fundamental analysis and there's technical analysis. Now a lot of folks pay attention to fundamental analysis. That's where you're analyzing things like the balance sheet, the income statement. You're using that to determine a valuation of the stock based on fundamental factors. Things like earnings, things like book value, things like the amount of cash on the balance sheet, amount of debt on the balance sheet, all of those sorts of things. Now, fundamental analysis is a very useful tool for long-term valuations of stock prices. And if you believe the efficient market theory, which says stock prices reflect all the information that's available for a stock on any given time, then fundamental analysis makes a lot of sense. And over the long term, it works. But we're option traders. We're not that interested in the long term. We're interested in short-term stock price movements and how to use options to profit off of that. In order to understand how stocks move on the short term, you have to understand technical analysis. Technical analysis is basically reading stock chart patterns, taking a look at what past price and volume performance on the stock and how it relates into the future, trying to project that into the future. This technical analysis is a lot of emotion. If you take a look at a chart of a stock, that tells you the emotion behind that stock. Because let's face it, the market's made up of human beings, and human beings act emotionally. You can't logically explain the internet mania back in 2000. Why were stocks like Pets.com, which were fundamentally worthless companies, shooting to the moon? Eventually they did come back down, and they were proven to be worthless, but for some particular period of time, you had market emotion, you had investor psychology running those stocks up there. So as a technical analyst, we take a look at stock patterns, chart patterns, use the past price and volume performance of the stock, and use it to project what it ought to be doing in the future. Let's take a look at some basic chart patterns. Let's say you have a stock that's simply trading in a very simple pattern between support and resistance. Here's a stock, let's say it's Newmont Mining. It's a good example. Stock trades between $50 and $60 a share. This is what's called a trading channel. Every time the stock comes down to $50 a share, buyers seem to come in and help support the price of the stock. Every time the stock gets up to $60 a share, sellers come in and help push the price of the stock down. Now, technical analysts really are just experts at playing connect the dots. All you do in order to set the chart up is you can draw a line across all the support lines, connect the dots, and you can draw a line against all the resistance lines and connect the dots. Every time the stock hits down around 50, buyers come in, stock moves up. Every time it gets up around 60, sellers come in and the stock moves down. So this is a very easy stock to trade in between $50 and $60 a share. Gets down to 50, you buy it. Gets up around 60, you sell it. So this is a consolidating pattern. Stock trades pretty consistently between 50 and 60. So if you're interested in trading this stock, using options to trade this stock, you take a look at a pattern like this and you see that every time the stock comes down around $50 a share, buyers step in. Well, that's a pretty good place to buy call options. You see every time the stock gets up around $60 a share, sellers come in. Well, that's a pretty good time to take a profit on your call options and to buy some put options. And you can go back and forth with that all the time. Now this looks pretty simple and it's really not much more complicated than that, but patterns do tend to emerge out of this. If you look over time, there are basically 5 simple chart patterns that exist in a stock, and we'll cover all those in just a second. One chart tends to often morph into another. So when you notice certain patterns like this and they become fairly predictable, you want to watch for signs that it's about to morph into something else. For example, let's say, we've got the stock up here around $60 a share, and it busts through that level. That's what we call a breakout. Whenever a stock breaks out of a consolidating pattern, it tends to pick up a lot of momentum. In fact, that's usually when you get the most violent and most rapid move to the upside. And I'll explain why. If you're trading this stock and you see that it trades between $50 and $60 a share fairly consistently, you see every other time that stock has hit $60 a share before, it's always sold off. So if you're trading that stock, you know it's at 60, it's probably time to sell it. And everybody else who pays attention to technical analysis is reading the same thing. They're looking at the stock at 60. They know it's time to sell it. So you have all this selling pressure. Everybody who has a reason to sell is selling the stock. And yet there's still more than enough buying pressure to help push that stock higher. That means there's probably something fundamental going on with the company that justifies the higher price. When you get this situation here, where the stock has been able to break out above a resistance level, there's no sellers left. Everybody was supposed to sell at 60. Everybody who was going to sell has sold. Now all you have are buyers. That's when you get the most rapid and most violent move to the upside. That's an ideal spot at which to buy call options. Because from a short-term trading perspective, you're not going to see too many situations where the stock's going to move faster than it does when you have an upside breakout. Take the counter side to that. Let's say the stock gets down here around, well, let's just bring it all the way back down. Stock comes all the way back down, and this happens every once in a while too. I'll just sidestep for a second, where you get this little breakout and you're supposed to get the most violent and wicked move to the upside, and instead it turns out to be a fake out. Stock rolls right back over. If it was as easy to make money in options as just simply drawing lines on a chart and playing connect the dots, we'd all be making a fortune doing it. But sometimes you have to be a little bit more flexible in the way that you draw the pattern. And every once in a while, you do get a pattern that fails. And so if you jumped in here and bought call options, and that pattern rolls right back down, this is where you sell call options. You get rid of them. You admit that you failed on that trade, the trade didn't work out, and you move on to something else. And we'll show you an example of that in a later DVD series. Come back down here, now the stock's come all the way back down to $50 a share. Every other time in the past where the stock has come down to $50 a share, buyers have stepped up, stock's moved up off of it. So that's usually a pretty good spot at which to buy call options. You'd buy it over here at $50 a share, and everybody else who pays attention to technical analysis is going to look at that and do the same thing. And son of a gun, it ought to bounce. Now, if for some reason you're paying attention to technical analysis, you're buying the stock here at $50 a share, it ought to bounce because everybody else is buying it too, but it doesn't, and it continues on lower. Well, think about this for a second. Everybody who paid attention to technical analysis, everybody who had a reason to buy it at $50 a share has bought it. Stock still fell. That means there's more sellers than there are buyers. Well, the sellers at that level, they're not technical analysts, they're fundamental. So there's probably something fundamentally wrong with the company that it can't hold that particular support level. So if you bought calls at this level and you get a breakdown on the stock, you get out of that position because on a breakdown, that's when you get the most violent and most wicked move to the downside. This is an ideal spot at which to buy put options. And eventually what happens is the stock will find a new support level and a new resistance level. It'll come on down and trade until buyers, fundamental buyers typically, think it represents a good enough value to jump in, and it'll form another support and resistance line. Now usually when a stock breaks above resistance or breaks below support, these lines switch personalities. Stock that breaks above resistance usually goes on up until it finds some sellers, fundamentally, then comes on back down, and this former resistance line should now serve as a support line. So if you're buying the stock here or you're buying call options on the stock here, the stock should not come back down and trade below that level again. If it does, the pattern fails and you're out of the position. Over on this side, this former support line, we get a breakdown, it now becomes resistance. If the stock comes on back up and tests that resistance level, it ought to not get above that if we're still going to make money on the downside on this particular position. And we'll go through a few examples that show you how this basically works when we're trading actual options. Now, over the history of time, I forget who did it, but in 1970, somebody published a study that showed if you look at every single chart of every single company and every single product over the history of time, you come up with 5 basic chart patterns. So it's useful to know those chart patterns. Let's take a look at them. First pattern we're going to look at is something called a rising channel. It's basically where you have a series of higher highs and higher lows. Little channel. So the stock goes up, makes a high, gets a little bit of selling pressure. Stock goes up, makes a higher high, A little bit of selling pressure, but makes a higher low as well. Higher highs and higher lows, this is called a rising channel. You want to own stocks that are in a rising channel. This is a very healthy chart pattern. It shows stocks moving up in price, correcting a little bit and relaxing some of the overbought condition. Moving up again in price, correcting a little bit, relaxing the overbought position, moving up again, all of this sort of stuff. This is a beautiful chart. You want to own stocks. And if you're drawing charts, support and resistance, you can draw an easy support and resistance line here. So we can play connect the dots and simply draw a support line, connecting all the low points. And we can play connect the dots again, draw another line, connecting all the high points. And there's your support and resistance. And as long as you have that channel in place, you might as well own that stock. Or from an option perspective, you want to own calls on this particular stock. Now, when you get up to this level, these patterns, stocks don't go up forever and they don't go up to the moon. So the pattern that typically comes in after this is you get sort of a consolidating, high-level consolidating pattern, where the stock just sort of goes back and forth between a fairly tight range up at a high level. It's called a high-level consolidation. Now, if you own call options on this, stock's not going anywhere, no reason to own them anymore. So usually, the best spot to take your profits on that position is when you break this support line. You see this channel with consistently higher lows. As soon as it fails to make a higher low, that's when you get out of the position, take profits on that trade. And there really isn't anything to do with options at this particular time. The stock is trendless. It's consolidating. It's storing up energy for the next move. See, this is important to understand because stocks are only in two gears. They have a trending gear and they have a consolidating gear. When they're trending, you want to be in position. You want to ride this trend as long as it'll take you. But when they start consolidating, there's really nothing to do there. If you own the stock, this is an ideal spot at which to sell covered calls. But if you're trading options, you're trading from the buy side and you've owned calls all the way up, this is the spot where you take profits on it, and you just sort of wait until you see the stock starting to trend again. And you'll notice what happens in a high-level consolidation is we can still play connect the dots. We'll draw lines, support line here, resistance line up here. And we'll wait to see what happens. If the stock breaks out of that high-level consolidation, odds are it's going to go into another rising channel, and you'll be able to trade that. Stock breaks down from that consolidation, then we have the other side of the equation. So let's take a look at that. Oftentimes, when you look at stocks, you look at chart patterns of stocks, and you see this sort of going on here. You get this high-level consolidation. Following a high-level consolidation, you'll often see a breakdown. And here again, we had a situation where we had support along the high-level consolidation, all the lows. Everybody jumped in, bought the stock here, sold it here, bought it here, sold it here, bought it here, sold it here. Here, everybody's supposed to buy it again. Stock still went down. This is called a rollover. This is a rollover pattern. It's basically where the stock fails to break to the upside of a high-level consolidation, and it starts to break down. This is the time where if you own the stock, you get the heck out of Dodge, and if you don't own the stock, you buy puts on it. Because a breakdown from a high-level consolidation is when you get the most violent and wicked move to the downside. In fact, if you look at a lot of charts, and we'll show you a few, these things often wind up doing something like this. It's straight down. When you look at charts, or you pay attention to stock prices, you'll notice something interesting. Stocks go up, stocks go down. They tend to go down a whole lot faster than they go up. Why? Well, it's emotion again. People don't like to lose money, and people get very emotional when they do lose money. It's wonderful when we're all making money and stocks are going up, but you very rarely hear of a buying panic. I mean, it doesn't happen. Oh my God, get me in. It doesn't happen. You do often hear of selling panics, and that's typically what happens because as soon as the stock starts to break down and it loses 3, 4, 5% on a day, people get a little emotional about that and they're willing to jump out of the position very quickly. It's one of the reasons why if I have to choose between trading calls or trading puts, I love trading puts because trading puts you make money a whole lot faster than trading calls because the violence to the downside is so much more extreme. And this is exactly where you want to buy puts. Stock breaks down from a high-level consolidation, suffers a rollover, and it goes into what we call a steep decline. Okay? In textbooks, you could say, I'm going to erase this real quick and show you, expand the pattern a little bit. Steep decline often takes the form of a downward channel. So here again we have a series of lower highs and lower lows. It's the opposite of a rising channel, it's a declining channel. So the stock's making its way lower. In this particular type of a pattern, you want to own puts, and you want to own it while that stock is trending. Stock is now in a downtrend. Hang on to the puts as long as you possibly can while it's holding that downtrend. Get out here, always following a downtrend, a declining channel, you get what we call a low-level consolidation. So it's the mirror image of that previous chart we had up there. Here again, you've got a situation where you can buy at support, sell at resistance. You have this very tight pattern, but typically there's not much to do in this particular chart. The stock is now consolidating. It's storing up energy for the next move. What's the next move? Well, it could turn up, form a rising channel. It could break down and drop into another steep decline. So there's a number of different ways to read this, and it's really just a matter of, if you're trading options, it's a matter of waiting for the right chart pattern to emerge. You don't want to be buying options when you have a consolidating pattern. Consolidating patterns are perfect for selling options. If you like this particular stock from a fundamental basis, you think this is a good price to buy it, selling puts is a great option right here, a great strategy. Buying puts or buying calls in this particular position, it could take a long time before that stock starts to trend again. It's got to store up energy. So when you're buying options, time works against you. Remember, the closer and closer you get to option expiration day, without that stock doing anything, the more that option price decays and the more money you lose as you're waiting for something to happen. It's far better to wait until the stock is trending before making a move and buying a particular call or put option. So you can see some of the basic chart patterns and some of the ways that we can use those to determine what sort of option trades work best. Let's do a quick review of putting everything together. We started off with a rising channel. So we have a stock that basically is making a series of higher highs and higher lows. Then we have a high-level consolidation, where the stock is just bouncing back and forth between a fairly tight support and resistance level, consolidating, storing up energy for the next move. Following that is a very short-term pattern called a rollover. Now, I went over that fairly quickly because there really isn't anything to do here. You don't really want to be trading any sort of options in this situation except being prepared, because this is telling you that the stock is about ready to make a trend change. In other words, we went from a rising channel, high-level consolidation, and we're breaking down. This is kind of like the caution sign. This is a warning light that we're about to experience probably something bad. So as soon as you see it break these particular support lines, that's probably where you want to pick up some puts, because what comes after that is one of these steep declines, where the stock tends to drop very quickly and you get the most violent and wicked move to the downside. You definitely want to be owning puts here. Following this, typically you get a period of low-level consolidation, where once again the stock is building up energy for the next trend. Now, if the next trend is down, you'll see it break down through its support line, take another sharp drop. If the next trend is going to be higher, well, it'll break up above its resistance line and get ready for, or begin a new rising channel mode. Look at any chart of any stock over time and you'll see evidence of this, the 5 basic chart patterns: the rising channel, the high-level consolidation, the rollover, the steep decline, the low-level consolidation. And there's something you can do with options in every one of these. Rising channel, you want to own calls. High-level consolidation, selling covered calls is a good idea. Rollover, you're getting ready to buy puts. You want to buy puts as the steep decline begins. Low-level consolidation, selling covered calls is a good idea. Selling uncovered puts works out pretty well here. Now you'll notice never in here did I talk about selling uncovered calls. And if you remember from the previous DVD series, you know why you don't sell uncovered calls. The risk just doesn't make sense. I will tell you a little bit, however, when you have a pattern, when you have a stock that is going through a rising channel, call premiums tend to inflate because everybody expects that rising channel to continue on forever. So people are willing to pay more for call options than they are for, say, put options at that time. When you have a stock that goes through a steep decline, Put options tend to inflate quite rapidly in price relative to call options because people are worried, they're scared, they're willing to pay more for put options to protect their position or to speculate on the downside. And when you have periods of consolidation, particularly low-level consolidation, that's usually when option prices are fairly cheap because there's not a lot of volatility, there's not a lot of movement, nobody really expects anything much to happen with this particular stock. So call options and put options tend to be cheap, so if you have a particular feel fundamentally for the stock, not a bad idea as soon as you see it break one of those support or resistance lines to jump in and either buy the calls or buy the puts. Let me give you a couple of other examples of stocks. Stock chart patterns. Not quite as common, but occur fairly often. Let's say you've got a stock that's just bouncing along a little bit, and one day maybe it announces earnings, maybe it announces a new product development, maybe a cure for cancer, stock shoots up on the news. This is a nice little spike in trading. If you happen to own the stock here, that's wonderful, everything's great. But most of the time, if you're an option trader, you don't own it. This is a consolidating pattern. You're not in this position. All of a sudden, you see this huge spike, and you think, oh, it's too late to do anything with that. Well, usually what happens here, following this big spike, is you get this little profit-taking, quasi-consolidating pattern. This is called a flag pattern. Love flag patterns. It's based on the premise that good news tends to follow good news. Essentially what happens is, again, you have a stock that's been consolidating, storing up energy, and then bang, overnight, big pop in the share price. A lot of folks think, oh, they missed it. A lot of folks decide to take profits, and you see this very short-term flag being generated. That's the design, is to look like a flag. If you get one pop, you almost always get two pops. This is a perfect time to buy call options in that situation because good news is often leads to more good news, and you almost always get a second spike higher. You don't always get a third, but you almost always get a second spike. Now the counter to that is a pennant pattern, where you have a stock that's trading along maybe a high-level consolidation, and then all of a sudden there's bad news. And you get this little bounce off the bottom. Now, a lot of folks like to buy stocks after they've been hit really hard. They think it's a bargain. They think it's an absolute steal to jump in and buy a stock that's been hit hard by bad news. Almost always a mistake. What's occurred here is basically you have a stock that consolidated for a while, built up energy, bang, got whacked down, got hit over the head with a sledgehammer. Now think about it. If you got hit over the head with a sledgehammer, would you get up right away and be all energetic? No. Odds are you'd probably stumble back to your feet a little bit woozy, and there's a pretty good chance you'd fall right back over again. It's almost exactly what happens every time when you get a pennant pattern. Stock gets hit over the head with a sledgehammer. Bargain hunters jump in right away thinking, oh goodness, it's 20% cheaper than it was yesterday, I'll jump in on this, without thinking about what might happen next. And almost always, just like with the flag pattern, good news follows good news. Pennant pattern, bad news often follows bad news, and you get another spike lower. You don't always get three, but you almost always get two. This little, we call it a dead cat bounce. This little dead cat bounce is a perfect time to jump in and buy put options. Let me explain the dead cat bounce. I don't know who it was, but some genius years ago figured out the way that best described falling stock prices is to take a dead cat and throw him off the top of the Empire State Building. He said when he hit the ground, it would bounce. And of course, then it would come back down and hit the ground again. Well, that's what we're talking about here. We're talking about the cat being thrown off the top of the Empire State Building, hitting the ground and bouncing. Actually, this is more like hitting the 15th floor and bouncing than coming back down and hitting the ground. All right, now the one final chart pattern I want to discuss in this particular DVD, another common one we use to trade off quite often, it's called a head and shoulders pattern. It's a very common pattern. You see it develop, you see a stock go up, make a new high, come back down, make a higher low, nothing new about that, make a higher high, come back down, fail to make a higher low. In fact, it'll come back down to the previous low, rally up again, fail to make a higher high, and then break down or come back down. This is called a head and shoulders pattern because you can look at it. This looks like shoulders, this looks like a head. A head and shoulders, this specifically is a head and shoulders top formation. This is a bearish chart or a potentially very bearish chart, and it often signals the change of trend from a bull market to a bear market. If we're looking at this with the S&P 500 being the example, This is a very big caution sign that the S&P 500 has gone from a bull trend and is shifting into a bear trend. Individual stocks, it's the same thing. The key to this, in a true head and shoulders pattern, is the difference between the head and the neckline is about 20%. The difference between whatever high point this is, if this is a stock, it's $100, the neckline is oftentimes somewhere around 80. I'm not sure why it is, but over time what's been figured out by a lot of technical analysts is if a stock has reversed course by 20%, if it loses more than 20% from its high, it's probably changed trend. So if the stock's been rallying a long time, gives back 20% of its value, odds are it's now in a bear market. And the same is true off the bottom. If you've got a stock that's been hit pretty hard and can manage to rally 20% off the bottom, that's a pretty good sign it's back into a bull market. If you look at a chart, the most glaring example of a head and shoulders pattern I can think of is October 19th, 1987. You have a situation where in 1987 the S&P 500 went up, made a new high in April, came back down, corrected, made a new high in August, came back down and corrected, and in early September it rallied up again, failed to make a new high, and then October 16th, 1987, it closed 19.6% below its all-time high. I remember those figures exactly because I was tormented by October 19, 1987, when the stock market did one of these things. Actually, a lot further than that. That was a perfect example of a head and shoulders pattern. If you can, go back and take a look at a chart and you'll see exactly what I'm talking about. If you see individual stocks, and I think this pattern works best with individual stocks, as soon as you lose 20%, that's a pretty good shot to buy puts. The reverse of this pattern is called a head and shoulders bottom formation, where you have stock that might be in a downtrending channel, comes down, makes a low, rallies up a little bit, makes a lower low, rallies up, fails to make a lower high, drops again, and comes on back. So here you have, here's your shoulders, here's your head. This is a reverse head and shoulders pattern, an inverse head and shoulders pattern. So you have a situation where a stock's in a downtrend, stays in a downtrend, comes back, fails to make a lower high, drops again, rallies back up, and oftentimes, again, the signal here is the difference between the point of the head and what we call the neckline is 20%. As soon as it can pop above that 20% level, oftentimes we're off to the races and we're back into a rising channel. This, my experience, this tends to work more often than a head and shoulders top formation. This is a bullish pattern, a potentially very bullish pattern that signals the reversal of a trend from a bear market to a bull market. And it's usually very quiet. A lot of folks don't pay attention. The stock's been in the downtrend. Nobody really wants to watch stocks that are falling, so nobody pays attention to it. So if you can find this pattern, odds are not a whole lot of people paying attention. There's a pretty good profit opportunity. If everybody's talking about, oh, the head and shoulders top formation, probably not that big a profit opportunity if everybody else is paying attention to it. So what we've talked about today are basic chart patterns. It's not all that complex. All you have to do is be able to draw lines and connect the dots on a chart. But what we'll do in the next DVD is we'll take a look at those specific chart patterns and the trigger points that you use to buy calls or buy puts or sell calls or sell puts. And we'll take a look at some of the trades that I've made over the past few months using these exact same chart patterns and what you can use in the future. So study the charts, play a little bit of connect the dots, and take a look at the next DVD series.